Now, as we go into Europe, we want to look at what are some of the things that have changed. There is some concern about Germany going into a double dip recession. And as we've been saying is we don't think there's a recession yet. We think that there's enough growth and you're starting to see that bounce. The question will be how much does new price pressures from Russia start to influence some of that? But right now you're starting to see some of the things that we saw coming to light. And when you look at the construction output in December, things were negative, but you're starting to see some of that reverting back. Now, even though some things are getting better, the consumer's still struggling. And consumer confidence expected at -8 came in at -8.8, and that's again some of that offsetting piece. But when you look at what the market PMI said, manufacturing was expected at 58.7, came in at 58.4. Again, kind of right in line with where we were thinking in terms of the manufacturing side. But services had a nice bounce. And this was something that is, again, we thought it was going to be good, but not as good as it was versus the services, where it was expected at 52.1, came in at 55.8. Now, when you go into the internals of that, it's still good. It's still obviously better than expectations, but a lot of that was driven by elevated pricing. And just given, as we showed last week, the softness that we're seeing in real income growth and real spending, that's going to have a longer term impact in terms of growth. And again, it's going to be positive, but it's going to bring us much lower in terms of what is actually happening in the underlying economy. But then when you look at inflation, still remains elevated, right in line with expectations of 5.1%. Month over month 0.3 and core at 2.3%. So there's still some of that mitigating factor, but the manufacturing sector is going to continue to be the bright spot, but given the backlogs and given now that you're getting some easing in the supply chain problems. But with that being said, and again, back to what are some of the driving pieces of the PMI beat, here's where you can look. The Euro area composite PMI output price surged. So when you look at just the increase in pricing, again, you're going back to 2003, this is an all-time high by a country mile, which again is going to become a bigger problem on how much the consumer is willing to spend, given that wages are just getting annihilated on a real wage side, and this inflation is going to continue to push through the system. And this is when you start looking at core producer output prices versus core goods CPI and the leading indicator side. And this is why we continue to see, and we've said before, that the Europe is behind the US on inflation. And a lot of this parabolic move that we've seen, they're now going to see in spades, really, because of what happens with Russia and what are some of those shifts and moves really mean in terms of price and pressure on the underlying economy. Which is when you start looking at labor costs, they're trying to offset that. Again, labor costs are going up as they're trying to increase wages, but there's so much cost that they have to realize at the first time, initially, and how do you pass that through? How do you see some of this underlying growth in general when you have this labor cost going up and this difficulty of trying to recognize this cost, which again is leading to some of the slowdowns in margin, in profit, and some of the headwinds that we continue to see on the European companies. Now, Eurozone industrial production, again, you're right back into where we were before COVID. So we just think that we kind of hang within this range. If anything, we actually push closer to the highs, if not above this range, given some of the backlog. But here's what we've been talking about with input prices. Input prices, and again, if you look at the US, input prices have started to come down. Here, input prices are moving back to new highs, prices charged back to all-time new highs. And again, those are the key pieces where, yes, they're positive contribution to the underlying PMI number, especially on the services side, hence the beat. But how is that going to feed down? Can they, are consumers willing to pay for it, or you're going to start to see some of this rejection? And given how weak real wages have been, it's likely, and the fact that the consumer in Europe is already so much weaker than the U.S. consumer, that is going to lead to a bit more pressure. But it's still positive. It's still, we say pressure in terms of the elevated level, big spike to above 55. We're not saying that you're going to drop to 48, but it's closer to a 52, 53, and you're going to see that consolidation, which is still going to lead to some of this growth. So then when you look at Germany, PPI exploded, was expected to be at 24.4%, came in at 25. Month over month was expected at 1.5%, came in at 2.2%. Again, all of that leading to a lot of these underlying problems. German manufacturing was expected at 59.8, came in at 58.5, and a lot of that drop was because the things have got a bit better on the supply chain, which again is a bit negative in terms of it's a positive for the economy, but how the number is calculated is a negative, which again is counterintuitive, but some of those different pieces. Services PMI had a nice beat, was expected at 53.1, came in at 56.6, again, bringing the composite to 56.2. So you're seeing some of that positive nature that we're seeing in services, but a lot of that was driven by an increase in price, and we do think that there's going to be some rejection and the consumer slowing. But business climate was expected to be at 96.5, came in at 98.9. Current assessment was expected to be at 96.5, came in at 98.6. IFO expectations was expected at 96.2, and it came in at 99.2. So again, the business is looking better, again, to the manufacturing side, but then the consumer confidence projected for March was expected at negative 6.3, came in at negative 8.1. That's what we're talking about in terms of the manufacturing. The business side will remain a bit better, especially on the export front. But the local consumer, given where prices are, prices paid, prices received, real wages, that's where the consumer is like, even though things look pretty good, that's a bit tough. And that's going to weigh on some of this positive nature on the corporate side, which again is going to mitigate some of that drop, some of the increase in GDP growth, but it will also keep us from going negative and getting some of that, the recessionary fears. And then when you look at business climate, so here when you look at manufacturing, everything is positive. Things are looking a bit better. Service sector, strong bounce off the bottom, which we think mitigate, flatlines a bit given some of the prices we've talked about. Trade will continue to improve. When you look at where the business expectations are, you're almost back to positive. And that's something that we think continues to move forward as construction has flatlined, and we think construction is going to remain an overhang given the weakness in the consumer as well as those shortfalls in the supply chain. So then when we compare some of this headline components to the U.S., here's where you get an idea of what we're talking about on headline inflation in Europe and headline inflation in the U.S. So when you look over where some of these things are, here you can see Europe is seeing a little bit of flatlining, but the U.S., especially on core CPI, is ahead of where they are. Now Europe is not going to catch up completely, but this shows you that the kind of trend that we're going to see and how Europe is going to continue to see some of these inflationary pressures as they catch up a bit with the U.S. So then when you look at inflation excluding food and energy, you get an idea of where the U.S. sits and where Europe is. And when you exclude some of that, the core pieces really started to kick up and in April and May of last year, and that's something where you're starting to see some of that acceleration in Europe, and that's going to continue as prices are just now getting pushed through. You're starting to see some of these increases, and again, that's going to be some of that driving force as we go through the remainder of the year. Then when you look at France, you can see that employment rate was expected at unemployment rate was expected at 7.8, came in at 7.4. CPI a little bit higher than expected at 0.2. Everything else in terms of year over year, very much in line at 2.9%. Services PMI was expected at 54, came in at 57.9. Manufacturing was expected at 55.5, came in at 57.6. Composite was expected at 53, came in at 57.4. France, as we've been saying, is a bit more of the bright spot versus Germany on some of those fronts. And then on the business confidence, manufacturing confidence, all of that came in above expectations. So France continues to be more of the bright spot, more of the positives as we go forward. And that's something that we think is going to continue, again, kind of bridging some of the gap in terms of where European growth is going to be and what the German kind of bumping along the bottom is going to do. This will be a bit of that bright spot. But then when you look at wages, so when you look at the U.S., compensation has continued to go up. But then when you look at annual in the Euro region, you can see it's still lagging where we were in both 19 and 20. And that's where we're going to see some of this increase. And that's, again, going to offset some of that growth that we've been talking about and some of those problems that are going to continue to kind of rear their head in terms of local consumer consumption and what the consumer is going to do in that region. And obviously, COVID had a decent hit. Germany may have fallen into its second recession since the pandemic erupted. Here's where we talk about how we do see this bounce in terms of that quarter, and we won't see. I think that some of that fear won't be realized as they will be able to eke out some growth, avoiding the normal term of recession, which is 2 consecutive quarters of negative growth. Now, just rounding it out, when we look at Spain, you can see that CPI a bit higher than expectations, was expected to be at negative 0.5, came in at negative 0.4. Year over year came in at 6.1%. And again, Spain continues to be a struggling point, especially when you think about how they rely so much on tourism, and the local consumer still continues to be a problem, especially when you look at real wages and this inflationary pressure that they see in this region. So that's what we have for you on Europe. In the next segment, we're going to go deeper into not only just emerging markets, but also China, as we provide some additional updates on the Asian front.